Hello, and welcome to Compound Club. Have you ever wondered when you actually need to own a stock to receive its dividend? Many investors assume that if they buy before the company pays out, they'll automatically get the dividend, but that's not quite how it works. In this video, we'll break down the ex-dividend date, what it means, why it matters, and how it fits into the dividend timeline. By the end, you'll know exactly when you need to buy and when it's too late. Every dividend payment follows the same 4 key dates. First is the declaration date when the company announces the dividend amount and payment schedule. Second is the record date, the day the company checks its records to see who officially owns shares. Third is the ex-dividend date, and this one's crucial. It determines who will receive the dividend. And finally, the payment date, when the money actually lands in your account. The ex-dividend date, often called the X date, is the most important for investors to understand. It's the first day a stock trades without the upcoming dividend attached. If you buy the stock on or after the ex-dividend date, you will not receive the next dividend. To qualify, you must buy before the ex-dividend date. For example, if the record date is Thursday, the ex-dividend date is usually the day before Wednesday. This means you must buy the stock on Tuesday or earlier to be eligible for that dividend. On the morning of the ex-dividend date, something interesting happens. The stock's price often drops by roughly the amount of the dividend. Why? Because new buyers after that point aren't entitled to the payment. So the value of the dividend is effectively removed from the share price. A few common mistakes catch new investors off guard. Mistake number 1, buying on the ex-dividend date, thinking you'll still get the payout. You won't. It's already too late. Mistake number 2, selling right after the record date. Even though you'll still receive the dividend, remember that the share price often adjusts downward. And finally, chasing dividends just for the payout usually doesn't pay off long term. Focus instead on companies with consistent, sustainable dividend growth. So, to recap, to receive a dividend, you must own the stock before the ex-dividend date. That's the key cutoff point every investor should know. Check your broker's dividend calendar or the company's investor relations page to confirm the dates. They're always published in advance. If you found this video helpful, give it a like, subscribe for more investing education, and share it with someone learning about dividends.